Welcome back to the Personal Finance Project. Today, Scott and I are joined by Joe Hodes. Joe is a director of research here at Baird on the Specialized Asset Management or SAM team, and he's been with that team since 2021. Joe earned his Bachelor of Science in Accounting, Finance, and Business Economics from Marquette University in 2015 and went on to earn his Chartered Financial Analyst designation or CFA in 2018. Joe, welcome to the show.
Thanks for having me. Great to be here.
Well, before we get started on how all the topics we wish to touch on today, can you just tell us a little bit about how you ended up at Baird and what working on the SAM team entails? Kind of what's the background for you there?
Yeah, definitely. So I have been a research analyst for 10 years. I started out um, right out of school as a analyst researching the semiconductor sector at a bank in Chicago. And over time, I've expanded my research coverage. I worked at a mutual fund company, covered the entire technology industry across various cap sizes. And then on the same team, what we do is we build customized portfolios based on a core of large cap holdings. So I cover companies of various sectors. And along with our team members, we build large cap stock portfolios. We actively manage those portfolios, and then we surround it with funds, fixed income funds, mid cap funds, small cap funds to create a diversified asset allocation that's customized to unique individual needs. And we do that on behalf of Baird's financial advisors for thousands of clients all over the US.
Joe, you mentioned a couple times there active management. I'm just kind of curious as we're 15 years into index love, basically, where all you hear about is the S&P 500 and how great it's done and how you'd be a fool to do anything different. Can you just give us a few ideas on why today, after a long period of good returns from the index, why you would want to be actively managing your portfolio?
Sure. I mean, you're right. First of all, to acknowledge this is a historically great period to have been invested in American equities, and we still think that's a great core of any portfolio. But I think the way we approach our active management style is that there's certainly a opportunity and a role for passive to play in client portfolios, and it's low cost. It can be tax efficient, especially if you're younger and you're dollar cost averaging. It can be a very easy way to get access to the market, but it's important also to realize, that there's a difference between the headline numbers and the percentage returns you see pushed to you from CNBC and what you own when you purchase the S&P 500 and why that's different now than in other periods of history. So we focus on creating a core of very high quality companies, many of which are S&P 500 constituents, but they don't necessarily align with, the concentration that's currently part of the S&P 500. Versus, vis-a-vis various indices or just the 10 largest constituents. And we try to, create a tailored portfolio for clients based on their needs for income that may be different than the dividend yield offered by the S&P 500, their need for downside protection that may be different than what they can generate with passive investing. And really just a focus on quality companies that we think have good growth opportunities and also offer attractive risk rewards that could be different in some ways than what you're getting from the passive index.
Yeah, and I think something that we had kind of briefly touched on offline was the S&P 500 has largely been regarded as essentially the benchmark where everybody everywhere, kind of irrespective of their own personal needs or their own personal risk appetite, they seem to benchmark their asset managers or hired advisors against the S&P 500. And Scott and I have long counseled our clients on how that isn't really a good representation of the things that we are trying to accomplish with their money. And it sounds like, kind of based on your description of the SAM team, I'm sure you guys are very well aware, right down to you could probably give us an analysis of exactly which securities contributed what to the total return of the S&P 500 within a couple of decimal points. You're totally aware of what the passive strategies are doing, but it sounds like you take a more proactive approach to customization, which allows a client to tailor a portfolio to their specific needs. But I'm venturing, even in you guys' business, that people will try to venture off the fairway from time to time and get distracted by what these more growth oriented kind of passive strategies are doing. And how do you guide people away from this feeling of this fear of missing out? Essentially, is like Scott and you alluded to, 15 years of the S&P 500 index doing tremendously, and maybe some people can be distracted by that.
Yeah, I think in any period there's going to be something that's performing very well and appears low risk because people are measuring risk as a, um, you know, as a product of historical returns. And there were times where that was international equities. There were times where that's been different alternative assets. And right now we're in a period where the American equity market is just far outperforming pretty much anything else over a long period of time. And to your point, I think that's worked out well for a lot of people, but it doesn't necessarily mean that those returns will continue. And anytime you're in a period where historical returns have been very, very good and have come as a result in part of valuation expansion, it makes sense to really take a hard look at what you own and what you expect the returns to be going forward for that asset, um, and to diversify. And so that's the approach that we take, where we try to focus our clients' interests on what's their financial plan, what are their needs, how can we help you accomplish it, and not necessarily, hey, can we beat, you know, whatever benchmark it might be, in this case, the S&P 500 in every period, but more so over a longer period of time when you have these peaks and valleys and the benchmarks, can we steadily create the outcome for you where you can afford to do all the things that you want to do for your family, you can afford to retire with the income that you'd like to generate, and you can set up the next generation for success as well. And in some cases, that can be a heavyweight to passive indices, but in most cases, it's a little more customized than that. And we use different asset classes to create an outcome where, regardless of what's happening in the market, you can still achieve your financial goals.
Yeah, and Joe, the vast majority of the people that we work with are retired. We've talked about that with you a little bit. And I think that sometimes it's difficult, especially in retirement, when you see a whole lot of stuff like on CNBC or Fox Business, wherever it is, about all these different investment ideas that are being kind of thrust in front of you. What should my goal be? And I think what you touched on, I think a really, really good point, which is the goal is to cover what you want to live on for the rest of your life and do so as comfortably as possible. And if that is completely detached from any kind of index, that's okay.
Right. Yeah, I think it can be tempting sometimes to look at historical averages and say, well, over history, on average, someone would have done very, very well by only having a pure equity portfolio, or even sometimes using leverage. And that might be true, but any individual doesn't get the average outcome. They get one single outcome based on how they invest their securities. And so, um, the theme that we like to resonate with when we're talking to our clients is, you have one career and you have one set of savings. We don't need you to try to get rich twice, basically. And in a lot of cases, our clients have won the game in a way. They've had a long, successful career. They've done a great job saving. In many cases, they've started businesses or run businesses or sold businesses. And our goal is to first protect that nest egg and make sure that it can help them achieve all the things that they want to, and not try to, multiply wealth in a way that takes on undue risk, and creates an outcome where we're looking somebody in the face and saying, hey, we made a mistake and you have to go back to work, or you can't do the things for your kids or for your retirement that you wanted to do. And that's our primary focus day in and day out, is just making sure that we're not creating a situation where the portfolio blows up.
Yeah,
Yeah.
Greg, before you jump in, I was going to say, just because it kind of aligns with something we talked about recently, I have kind of a silly saying I use, which is,
I
what
was
is
just
it
about
we're
to
trying
say
to do here? Go ahead.
I was just about to say that. Yeah. Well, I mean, Scott is very good about guiding clients to having some preconceived notion of what the goal of the investment venture is. And then once it's been achieved, to leave the ball in the end zone. It's saying you've sufficiently grown your capital to where you can cover every single dollar that you need to spend out of your portfolio and have some left over. So what are we doing examining individual stock picks that really have only two possible outcomes? They might make you a lot of money in a very short period, or you might end up with nothing left at the end of that venture. And so Scott has distilled that down to, what are we doing here? What is the point of this investment? And I think that one of the things that we've tried to touch on with our clients, where they will indicate, passive strategies have done a little bit better, is the index is a totally dispassionate vehicle. It has absolutely no mandate to preserve your capital whatsoever. So in a market where you've got a really top heavy index, and we saw this with Netflix not that long ago with, I don't even think their subscriber base shrank. It's just it didn't grow as fast as they thought it would, or hadn't grown as fast as it did historically. and it got hit really, really hard. And so maybe Joe, you could talk a little bit about how, not mentioning any names specifically, that the S&P 500 index today, as of today, the index fund of today, is not the same thing that was launched by Jack Bogle maybe in 1975 or 1976. Like those two vehicles are very different now.
Yeah, I think the way that investors should think about the S&P 500 is that it's a tracking mechanism for the largest companies in the world weighted by the market capitalization. So when you buy or own the S&P 500, what you own is the exact, you know, weighting of each company as other investors have bid it up historically. And as passive has grown as a share of the overall investment market, every dollar that somebody invests into a passive vehicle, buys Apple at 7%, buys Microsoft at roughly 7%, buys Nvidia at roughly 8%, and continues to perpetuate the prior weightings. And, you know, especially after these periods of really strong performance, what happens to a lot of these companies that have gotten very large is that the expectation is for those companies to continue their prior success. But just like anything you're making an investment in, as you have past historical performance, it creates a higher and higher bar for that performance to continue. So that in the Netflix example, you could attribute this to really any company that has a lot of success, and then a lot of people jump in and invest, and they expect that to continue, but really just creates a tougher comparison for that company going forward. And so the way that we build our portfolio, rather than taking a top down approach of, hey, we're going to allocate this much to this size of company and this much to this size of company, is we call it bottoms up investing, where we start with the company's financials, we go through their filings, we meet with the management teams, we create our own definition of what we think this company's earnings stream can do in the future. And then here's the multiple that we're willing to pay for that company. And in some cases, there's large and successful companies that we also own in size. But in a lot of cases, the stuff that we own is unique or is owned in much different weights than the S&P 500, because we feel that other investors or passive investors' expectations have either risen too high in some examples or have fallen too low in other examples, and created inefficiencies that we can exploit. And as more and more of the market has moved to passive, more and more of those inefficiencies have been created, where now there's a lot of people who are investing without looking at the fundamentals at all. They're just, putting money into the index, and that creates more opportunities for us going forward, especially as we look out over longer term periods where you can get market dislocations that we can take advantage of. Because as the market goes up or down 1% per day, a lot of constituents move a lot more than that and create opportunities for us.
Yeah, Joe, on that note, is it just me, or are there more companies that trade just completely detached from any kind of valuation metric than there were maybe 10 years ago? It seems like maybe it's a function of indexing, but it just seems like there's so many more companies trading at 100x, 200x, where it's just a growth story as opposed to some kind of earnings backing them up.
Yeah, I mean, the hurdle to get into the S&P 500 is profitability, and it's not like, oh, you have to be a certain amount of profitable. It's you have to be profitable. You have to generate a profit, and then if investors want to bid up something, and it becomes larger and it's already in the index, well, that's what you're buying anytime you put another dollar into a passive index. And so it just goes back to that same theme of making sure you understand what you own, and what the weights are, because there are certainly pockets of what I would consider very irrational prices for some companies based on very, very high expectations of the future. And when you step back, like, what you are buying when you invest in any company is you're buying a share of that company's cash flows from now until, the end of time. And there are companies where I have a very hard time understanding how investors think they're going to get their money back, basically, when they buy a share of the company at current valuations. And I think that's just a product of a lot of money chasing after some hot themes or some exciting narratives that historically we've seen create those blowups that I referenced earlier.
Yeah, and I think for the benefit of the listener, will you touch on how you guys will differentiate between what you think is performance attributable to just expansion of multiples, or the ability for a manager to actively identify companies that are growing their earnings faster than their peers? Because I don't think everybody really understands that distinction.
Yeah, I think when we think about what's the market going to do or what's any individual company going to do, it comes down to what's the earnings power of that company and how much cash can they generate and how much can they grow that cash flow. And there has to be an aspect of growth. Otherwise, we should just be invested in fixed income securities that can, provide a higher confidence level that they're going to throw off a certain amount of cash at certain scheduled dates, and then we'll get our principal back. With equities, you really want to be invested in companies that you think can compound over time and have a competitive advantage over, not only the existing competitors, but over potential competitors going forward. And so we isolate to focus on fundamentals. What is the company earning today? What is the value that they're providing to their customer base and to their ecosystem? And how can they turn a dollar that we invest in that company today into more than a dollar in the future, through a metric that we call return on invested capital? It's used by a lot of investors, but that has worked for us in the past. And I think it goes back to another advantage of active management is that you can look at academic studies that have tried to isolate for different metrics, and the quality metric has historically outperformed. Higher quality companies have outperformed lower quality companies. And while that sounds kind of obvious at face value, um, when you kind of look under the hood, it's companies that don't take undue risk in financial leverage by taking on too much debt, companies that can earn high margins, that can earn high returns on invested capital, and that can do so over time. And that's really what we try to focus on. And we try to, stay away from companies that might be exciting or generating really fast revenue growth in a short period of time, but doing it at margins we don't think are sustainable or that we don't think are impressive, and sticking away from companies where people seem to be implying very high expectations going forward, which is often reflected in valuation multiples. And maybe to put a finer point on it, like for any company that you invest in, you're going to get a return from two different areas. One is their ability to grow their cash flow going forward, and two is the multiple that people are willing to pay on that cash flow going to go up or down in the future. And so, ideally, we're invested in companies where we feel that the valuation metrics are reasonable. We're not necessarily counting on multiple expansion going forward, but we're counting on continued, or an acceleration in cash flow growth. But what can happen in a lot of cases is you can have companies that they can grow their earnings and their revenue and their margins very, very strongly. But if the expectations were in too high of a place going forward, the contraction in the valuation multiple can more than offset any growth that happens. And you've seen that as you look through the wreckage of the, tech bubble from 25 years ago. There's many companies that continue to grow very well, but it took years and years or decades to reach the prior price that they had been trading at when expectations got ahead of themselves.
Yeah, that's a good point because I think, something close to home for us, we're in Houston. So energy is something that really everybody that we work with has some hand in. You look at those energy companies and those two component pieces you talked about, their ability to grow earnings and multiple expansion, the multiple stays about the same on those companies. Most of them trade in this fairly tight window. So sometimes I'll have conversations where somebody wants to say put an energy company in a Roth IRA, and I'll look at it and say, well, do we think that the multiple is going to go from 14 to 30? Probably not. So how quickly do we think they're going to grow earnings at this stage when they're a super, super mature company?
Yeah, it's interesting. I mean, I think really you can extrapolate that to pretty much any company where you can have these cycles where there's just no enthusiasm for energy companies, for example. And so you really don't get much swings in valuation multiples. But if you look back over a longer period, there's pockets where people get really excited about energy because of demand for energy products outside of the US, for example, or because of excitement about pipelines, or there's been excitement recently about natural gas in fulfilling some of the electricity demand for artificial intelligence. And those examples occur in every sector um, of the economy where you get these periods of enthusiasm, periods of pessimism, and can create outcomes that are very different than the changes in the fundamentals.
And Joe, you just mentioned because AI was sort of one of the buzzwords or buzz phrases that we were hoping that we would touch on as a part of this podcast as well. But I think before we get there, well, it's kind of a related question. I think a lot of investment managers try to pay, or asset managers try to pay close attention to kind of the prevailing consumer psychology. is essentially trying to get a sense of how excited are people about a certain sector and whether or not our expectations will actually be met or exceeded, or perhaps we will be underwhelmed by the results we get out of a specific sector or just the market more broadly. And I think there's not a more topical area of the market than AI, where maybe consumer psychology is perhaps short term overly exuberant, but maybe long term actually underweighting its capabilities. How are you guys currently sort of, I don't know, how do you feel like the market or people feel about these sorts of companies right now?
Yeah, I think there's a ton of enthusiasm, and some of it is well placed. I mean, there is definitely a lot of investment and growing investment into this space, and it touches not only the, direct semiconductor companies that are making the chips that benefit most from the training cycle of AI algorithms, but different aspects of the industrial economy and different aspects of um, the energy space. And so what we try to do is, again, go back to isolate what do we think this company can achieve fundamentally, and then how wide do we think the band is around their ability to generate that earning stream. And so in some cases there's very exciting growth potential, but there's also a very, very wide band of probability where this company historically has not earned in a steady increasing way. There's been a lot of volatility. And so when you attribute more enthusiasm to something that people are really excited about growing a lot, you can get this kind of double whammy where you get very high expectations on cyclically high earnings, and it can create very difficult outcomes going forward. The reverse case can be, even over the last, 3 years since ChatGPT really became popularized, you've had periods where certain companies and the entire space of companies that touch AI have been viewed very, very positively or very, very negatively. And when you invest actively, you can flex your position sizes around your perceived enthusiasm and create outcomes that are better for your clients than just sort of sitting and waiting over that period and experiencing the highs and the lows. You can kind of express your view of other investors' enthusiasm by taking some weight out when people are too enthusiastic, and then putting some weight in when people are worried about DeepSeek or whatever news might pop up next. And that's sort of the fun of investing, is it's not only trying to figure out what's going to happen in the world, but trying to figure out what do other people think is going to happen in the world.
Right.
Makes it pretty exciting to be an active manager.
So it sounds like when you have a pretty good, I guess, grasp on where you value a company, you're pretty comfortable. Say it gets really popular for a little while, trades higher than you think, comes back down to earth, maybe goes below where you want. You're comfortable trading a company a couple times a year if something like that happens?
Yeah, I would say in general, we try to trade as infrequently as possible because we like to emphasize finding the best companies and then holding them over a long period of time, letting them compound. However, there's long stretches where we don't trade very much at all because things are happening pretty slowly. Things are going according to the plan that we set out. But there are periods of a lot of market volatility that are particularly exciting because they can allow us to do a lot more for our clients in short periods of time. When you get big moves in either direction, you can be more active. What comes to mind is the phrase that there's decades where nothing happens, and there's weeks where a decade happens, and that happens in the market all the time. And we experienced that earlier in 2025. We experienced it in 2022. You get some years where it just feels like, hey, it's steady up into the right, low volatility. And in that case, we're happy to stay invested in the high quality companies that we've identified. And then there's periods where suddenly people get very pessimistic, and we can say, hey, we've been waiting to make a move on this company for a long time. We thought there was too much excitement about the expectations going forward, even though we really like the management team and the fundamentals. Now we're going to use this as an opportunity. And then to your point on the flip side, it's, hey, now I'm hearing from, this taxi driver or whatever about how great of an investment opportunity this might be. And so it might be time to take some of our cards off the table, chips off the table. And so we've done that as well.
Yeah, we had a manager down here. I think he worked at Capital Group, and he talked about how one of their kind of investing axioms was always trying to take really healthy bites out of the middle. So they weren't ever really trying to sell a stock right at the apogee. They were really not trying to look for buy opportunities when they were deeply in the gutter. They were looking for high quality companies that had appreciated over a period of time, and they generally held those for a few years, but they were not afraid of thinking that everybody was going to continue to bid the price up a little bit more. So we felt like if they got 75 to 80% of the returns out of a company, that they were pretty happy to go ahead and take their profits and look for other ventures.
Yeah, I think anybody who tells you they can pick the bottom, pick the top, consistently is probably overstating their abilities. But going back to what Scott said earlier, it's about having a confident view of what's the real value of this company, and then being willing to express your view by, adding or trimming your positions when it gets really out of whack in one direction or the other.
So looking at the economy in general, with AI maybe being the thing that everyone has been talking about for 2 or 3 years now, is there any particular factor that you're really worried about in terms of things that could get the economy going in the wrong direction, like potentially inflation escalating again, maybe the tariff conversation from earlier this year?
Yeah, I mean, I think there's always reasons to be concerned, and certainly there are right now. You could have political disruption, you can have inflation resurgence. We've seen some pockets of the economy starting to weaken. I would say what we've heard recently from consumer companies is that consumers are still spending a lot. Unemployment still remains low, but there is signs of, well, auto loan delinquency is ticking up a little bit. Maybe there's signs that the economy is slowing down. There's other aspects where um, you look at ride sharing companies or food delivery companies accelerating growth in recent months, which shows you that there's pockets of the economy that are doing quite well. Not to mention, all the investment in AI capex, which is driving, a significant chunk of overall US GDP growth in 2025. There's a lot of excitement. And so we try not to invest based on a overall macro view. And what we try to do is find companies where not only are we excited about their ability to grow in the economy as it currently stands today, but we like that their management team has a track record of, remaining dynamic and acting quickly in periods of disruption. If you look at, the COVID crisis as a good example, some companies were quick to make changes to benefit their customers, help them gain market share, and accelerate, you know, secular trends that would have taken a decade, for example. But hey, in this period of disruption, we were able to provide a lot of value, and you shifted more of your budget over to us. Those are the types of companies we like to identify, rather than trying to say, hey, we're gonna, move our portfolios around based on some macro view. And I think if you go back in history, there's always been reasons to be pessimistic, but to be a successful investor, you have to sort of lean optimistic and think about how things can go right, while also protecting your portfolio from getting overly enthusiastic about something and creating a situation where something blows up.
Yeah, and I
Yeah.
think I'm sure you guys saw it, or some of you saw it. J.P. Morgan put out this thing in January of this year, which demonstrated kind of where the S&P 500 sat from a valuation perspective. Said it was trading at a roughly 23 price to earnings, so just broadly. And they said that if you look back at rolling 10-year periods and you bought the market at a 23 PE, your subsequent annualized rate of return was somewhere between -2 and +2. And I think that this really scared some people and made them feel like why would you ever own stock if you feel like your forward-looking returns were somewhere between negative and +2? And the other thing, like you talked about, is the market will go through periods where just nothing really looks attractive from a macro level. Because right now, I think the earnings yield on the S&P 500 as compared to the yield on the 10-year Treasury is about as wide as it's been in a while, which would indicate that perhaps valuations are quite stretched. But from our perspective, you guys clearly have a selection process. And you don't have to take us through every little bit of insider information that you guys have, not to a specific company, but just to your specific process. Like, you don't have to give anything away that's proprietary. But when valuations are stretched and when it feels like opportunities to make money in the market are limited, what is that process? So how are you guys screening companies? Are there anything that is immediately disqualifying? What are the things you're looking for out of a management team? That kind of thing.
Yeah, it's a good question. I think the first thing I would say is that on the SAM team, the vast majority of our portfolios have equities as a component, but also have other asset classes such as fixed income, and our diversified portfolios that aren't necessarily reflective of just the valuation of the S&P 500 as a whole. The other thing I would say is that really our process doesn't have to change in periods where overall market valuations are higher, because we are looking at every company on an isolated basis and trying to identify what's the upside and downside scenario for this company based on, again, what's the stream of cash flows we think they can generate, and then how much are we paying for that stream of cash flows. And certainly we're always trying to allocate as much capital as we can into areas where we feel the opportunity is highest for returns going forward, and flex capital away from areas where we feel, you know, even if the company might be fantastic and run by a great management team, other people have recognized that as well, and that's reflected in the valuation. So it's a you know circuitous answer to say basically we don't necessarily change anything in it at all, but when the opportunities for investment in let's just pretend that everything in the market we thought was really expensive, well, you just kind of have to lower your expectations going forward. I think if you're exiting this period where the market has done very, very well, if we were unable to find anything great to invest in, then we would hold higher cash positions for our clients. And we're not going to invest in something just because we feel like we have to. We're going to invest in something because we like the opportunity that's presented at current prices.
Yeah, and Joe, I think you said something really good there, which was that you have to inherently be a little bit of an optimist if you're an equity investor. Being a perma bear is exhausting, and it's very difficult to actually make any money that way. So maybe valuations look a little stretched. We're going to look at the best options, try to find, like you said, bottoms up companies that make sense, and avoid the stuff that's the frothiest, I guess.
Right. Yeah, I think um, to the comparison of the earnings yield to bond yields too. There was a period in the 1950s where it was the first time that the dividend yield on equity markets had fallen below um, bond yields, and people at the time said this is outrageous. The market has to go down from here. Why would anyone own equities if you could get a higher yield from fixed income? And the answer has been growth. Like, you really have to have confidence that the potential of the companies you're owning is for earnings to grow going forward. Otherwise, you should just be in a fixed income vehicle, and we feel very confident that underpins every company we look at. What's their ability to compound earnings over time? Because that's how you can really generate great returns on a risk-adjusted basis. It's by owning companies where the earnings stream and the cash flow stream can get larger. And when valuation multiples are higher, you have to look out further, and there's more opportunity for disruption, I would say, if you have spikes in interest rates like we had in 2022. But the compounding nature of those companies does not necessarily change with the changes in valuation multiples in the market. And so encouraging our clients to take that longer term view and to invest alongside us for a longer period of time is really helpful as well. The average stock is held for something like 2 months. We hold companies for 5 years or longer. And so we feel like the game that we're playing is very different than the people that we're competing with, and most people who hold stocks. And we own these companies in individual accounts for each one of our clients specifically. And so we try to encourage them to think about it the same way we do. You're going to own these companies, you're going to own them for a very long time. And if you own bonds and you own them for the yield and the price of the bond, whips around, it doesn't necessarily matter for you as much. And we like to think about equities in the same way. You own a piece of a business, and the piece of the business does not necessarily change when the price of the stock changes. And so trying to focus on that long term is really helpful for us and helpful for our clients.
Yeah, and I think as sort of passive strategies where the PEs or the valuations are being stretched on average kind of by a few top-heavy players where the PEs have gotten, as Scott alluded to earlier, sort of way divorced from historic norms, there's kind of two parts of me that are competing on that, which is one, our sense is that buying overvalued securities or buying an overvalued asset is not good. We think forward or prospective returns have to be somewhat muted in order for this to come down to its sort of long-term average, or some mean reversion needs to happen. But on the other side of it, and this is something that a lot of people kind of in the popular media have alluded to for a while now, these companies that represent the top end of that S&P 500 we've been talking about, they're unusual from a historic perspective. So they are more profitable and they are far less capital intensive than the businesses that were at the top of the S&P 500. Like it felt like yesterday, ExxonMobil used to be the most valuable company in the S&P 500. That's a very capital intensive business, and it's no longer the case anymore. So what do you think about how, from a historic perspective, maybe that valuation metric isn't as ominous as it now appears?
Yeah, that's true. I would say two things. One is that, in any given period, valuation is a terrible predictor of what's going to happen in the markets the next year or two. It just really has not been a great predictor in the short to medium term for what's going to happen with equity. So anyone who's trying to time moving in or out of the market based on purely valuation alone for an entire portfolio has historically not had a very good time with it. The other thing I would say is you're absolutely right. Like the profit margins, the returns on invested capital of the largest constituents in the market are more than double, what they were 25 years ago. And there's a certain degree to which counting on mean reversion on valuation, implies that you think that companies are going to mean revert to the level of quality they were at that time as well. And to your point, that's just probably not going to happen. You have, phenomenal management teams, phenomenal business models, more recurring business models, less earnings volatility. And so to some degree, it makes sense to pay more for those assets. But I would also remind people that, part of the return you've gotten over the past 15 years has been the expansion of valuation multiples. And even if you argue that they don't need to mean revert back to some lower level, you are unlikely to get, that same tailwind that you've had going forward. And now future returns are more reliant on what is the growth of earnings and cash flow. If you get a company that goes from 10 times PE to 20 times PE to get the same percentage showing, you need to get to 40 times PE from here. And so it just makes sense to keep expectations in check, to understand what you own, to fit your assets into what's your financial plan, and to be prepared for more volatility going forward as well.
Final thought from me. I saw an article recently that was talking about stock ownership in the U.S. versus other countries, like say in Europe and Japan, I think a couple other places like that. And it was still saying that U.S. stock ownership is just far and away what it is in almost any other country outside of maybe some government pension plans. Do you think that there could be a headwind of more people abroad in the world as a whole having access to equity markets over the next 15 years?
The way that I would think about that is that, as the world gets richer, there's billions of people working hard every day to make outcomes better for each other, and not necessarily out of the kindness of their hearts, but because the economy is set up so that if you create great outcomes for other people, you can earn a living yourself. And as you get this sort of rising global middle class, that's a tailwind overall to equity ownership, as people recognize that equities historically have been a great place to put their money. And while some of that will flow to domestic stock markets in other countries, I think it's important to recognize as well that the best companies in the world and the ones that are multinational and can benefit from rising incomes in other countries as well are often large American companies that maybe they're headquartered in America, but many, a large portion of their sales comes from other countries as well. So I don't necessarily think of it as a tailwind or headwind to valuation multiples necessarily, but it's a good thing for the world, and it's a good thing for American companies to have more opportunities to sell more products and earn more profits and, make the world a better place.
Yeah, sounds good. I think that this has been a really productive conversation, kind of giving us an insight of what you guys over at the SAM team do. Wherever you are watching or listening to this podcast, please like and subscribe. And Joe, it was really great having you.
Great to be here. Anytime.
Yeah. Joe, really enjoyed it.
Thank you. Me too. Thanks. See you soon.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.